let's get into some updates just in general that have happened mortgage related, because there have been some things that are important that have changed over the past 2 weeks. There's one or two things that are pretty large. Other than that, though, just some minor things that are just really important and good to know. So first of all, starting off with some guidelines and program updates, there's been some clarified guidance on loan-to-value ratios if you're purchasing co-ops in New York. There's also some updated guidance on how we manage rental income for properties that are investment properties. Other major adjustments, this is the large one, employment authorization documentation citizens, people who are not U.S. citizens rather, but people who are in the U.S. with employment authorization cards with a certain visa type. The Federal Housing Finance Agency 2 weeks ago announced that level of documentation for eligibility purposes is no longer acceptable for FHA loans. It's still acceptable for conventional loans at this time, albeit some investors, some banks have what are called overlays, where they will take the baseline guidelines from Fannie Mae and Freddie Mac, your conventional guideline sources, and then they add additional ones so that it more clearly represents their credit appetite. So there are parts that they're trying to mitigate the risk. They may say, no, we won't accept this. So that's something to be aware of. That's an important update. Also, there's been some updates for qualified mortgages, and this is something that was from 2008. The Dodd-Frank Wall Street reform after the great financial crisis, amidst it, really, they created some new guidelines, and part of those guidelines were creating the qualified mortgage, which sets forth certain requirements that we need to document as a mortgage lender to ensure that there's an ability to repay the loan, that there's sufficient assets, that there's been a significant review of the credit profile of the borrower so that the loan is under this qualified mortgage guideline. There's also some loan modification deadlines that are upcoming. So FHA COVID-19 waterfall mods, they expire on April 30th. So that's coming up at the end of this month. And same goes for Fannie Mae and Freddie Mac Flex mods, which were types of loan modifications that were available during the COVID pandemic. That program ends on May 1st. So within a day of each other, these two things are now changing. Which brings me to my next highlight point. We are seeing a slight uptick in mortgage delinquencies. The core of this is really in the 30 to 60 day lates, and that is mostly from the data that we're seeing reported coming from FHA mortgages. So the current homeowners that have FHA financing are obviously looking to be under a little bit more financial stress, and they are falling behind on their mortgages. This isn't anything to ring an alarm bell over, but this is something that's important to note, especially right now with inflation persisting as it has been. We've talked at length about how the American consumer is significantly squeezed right now because of the higher cost for things. So this is an important data point to keep our eye on. The other part of that is that early stage delinquencies are the main driver, but there's also been an uptick in foreclosures. Month over month, we saw a 2% uptick in foreclosures. This is taking a look at the whole country. So this is not specific to the state of New Jersey. This is nationwide. And where we're seeing that is mostly in the harder hit areas when it comes to job losses, not as much job opportunity available in certain states like Louisiana, Mississippi, just to name a couple that came up in my research. So it's not something that's widespread, but a tick up in delinquencies foreshadows possibly a tick up in short sales and foreclosures. And then seeing that uptick in foreclosures means that there could be some cracks forming here with the American consumer and the American homeowner. I want to bring this up because this is also an important component of what it's going to look like as we go throughout the rest of this year. Inventory continues to be a struggle in the highly competitive markets. I'm situated in New Jersey, so here it's competitive. If you've ever gone out shopping for a home, you know with the more desirable properties, there's a line to get in for the open house. May not even be possible to get in for a private showing. And before you know it, there's a best and final. This is created from an environment of low supply. higher cost of financing is not helping. But obviously, that has not shown to be very prohibitive. People are still going out there and purchasing. So until we see more inventory, which I hate to say it, but foreclosures and distressed home sales, so that's short sales, those are homes that will be more inventory. That is the one market component that could open up some more inventory quickly, which anything happening quickly is going to shock the system. It won't be a good thing. And I'm talking not just exclusively about real estate. I'm also talking about mortgage rates. Mortgage rates drop very quickly. It's going to shock the system. If more homes become available, if a flood of homes hit the market, you're going to see home values decline. Now, that being said, what does decline look like? Does decline look like a compression on growth? Right now in North Jersey, some townships, you're seeing on average over the past 3 years, 10% per year cumulative annual growth, 10 to 15% on the value. That means 3-4 years ago now, you're sitting on almost 40% more equity in your home from when you purchased. That's insane. So maybe does more supply just mean, well, now we're looking at 2% price appreciation? Maybe that's what it is. I happen to be of the opinion that we're going to wind up seeing home value compression on value growth more so than home values dropping. I think that there's so much demand because of how many years have gone by. And I know it just from my small sampling of the families that I help. Well, how many of them, I'd say 20 to 30 different families that I'm currently assisting, helping them navigate preparations for buying. They come off their lease. They look for a couple months before their lease expires. They get beat out and then they go back. Now, some of that comes down to the strategy. And now we know a little bit more now. So some of those clients are able to have a winning strategy implemented to help. And that works. But sometimes there's not much tangible change to their budget. And now that when they go to revisit this, they're priced out. They have to make more concessions on the homes that they're interested in purchasing. So those are important things to take note of when, we're making our plans here. Point being this, we are waiting to see if we're going to get more inventory and what that's going to have as an effect on the market. We're going to have to see how that changes home values. Like I said, this is my personal opinion. I don't see the market fundamentals that are going to sink home prices. A 2008 level event was created by a radically different lending environment. There were so many other things at play in 2008. So anyone who looks at 2008 as a reason hey, home value is ripping this high. The last time this happened was 2008, and we all know what happened there. My only response to that is yes, that is true from a couple of the points of reference, but correlation is not causation. And secondly, we have a very different environment right now, what it takes to get a loan to purchase a home. You needed a pulse before 2008. Right now, we go through your tax returns, W-2s, pay stubs. We verify assets, income, credit, the whole nine. So if something's going to happen, it's going to be from the market. It's going to be from the job market. It's going to be from layoffs that would occur. Anything like that stresses out the American consumer, boom. That's where that's going to happen. It's not going to be from this big fallout from an industrial size issue that's going to pull the rug out. So 2008 is a good reference point to an extent, but I am not in the camp that believes something like 2008 is going to happen now with home values dropping significantly. I think they will compress a little bit, but we have to see. We don't know what it's going to look like. We don't know what a return to normal is going to look like, especially because interest rates continue to be volatile. And that becomes a difficulty to manage in the home buying process and for budgeting purposes.